Welcome to the Deep Dive. We're your shortcut to getting genuinely well-informed. We try to pack in surprising facts, maybe, just enough humor to keep you hooked. Today, we're diving deep into something timeless, really. How do you invest intelligently? Especially in this world that's just bursting with information, noise, constant next big things. Our mission for this deep dive? Well, we've looked at a stack of incredible sources. One key one is Benjamin Graham's The Intelligent Investor. You know, the book that literally shaped Warren Buffett's entire empire. We want to abstract those core, unchanging principles, the ones that actually build lasting wealth. What if the secret, right? What if the secret to building that wealth isn't chasing the latest market hype? What if it's about something, I don't know, more timeless, more grounded, and yeah, more intelligent?
Exactly. And look, this isn't about chasing those hot stock tips or the latest ticker symbols you see flying around. We're going to pull out the really vital insights here, the actual laws, you could say, of intelligent investing. So this means understanding why things like balance and simplicity consistently win out over complexity and fads, and the absolutely crucial idea of a margin of safety. That's your ultimate protection, really, and maybe the most critical piece. Why mastering your own emotions is often much more dangerous to your finances than any market crash. We'll show you how these principles, well, they aren't just theory. These are practical tools. Real people use them to build, generational wealth.
Okay, yeah. Let's unpack this then.
Yeah.
Because when we talk about intelligent investing, one name it inevitably comes up. Warren Buffett. It's truly remarkable how a single book, The Intelligent Investor, became like his foundational blueprint. He read it when he was 19, apparently just devoured it, and it set him on this path. Just unlike almost any other investor out there.
Yeah, and what's really illuminating when you look at the sources is that Buffett didn't just, read it. He internalized it. Every lesson, we're talking about those core ideas, like always building a robust margin of safety.
Which is basically buying something for much less than it's actually worth, right? Gives you a buffer.
Precisely. Buying an asset for significantly less than its calculated intrinsic value, it gives you that cushion against things going wrong. And he learned that a business's true value, its underlying worth based on earnings, assets, that kind of thing, is way more important than its fleeting market price.
Which can swing wildly based on just sentiment, yeah.
Totally. And maybe most crucially, the absolute necessity of emotional discipline. Graham famously taught him to buy businesses, not stocks.
That sounds simple, but it's profound.
It really is. It wasn't just a catchy phrase, it was a whole paradigm shift. It made Buffett stop chasing ticker symbols and start thinking about acquiring entire companies, like See's Candies, Chico, Coca-Cola. He started acting like private equity manager, essentially.
That is a powerful shift. So it sounds like Graham didn't just teach Buffett what to buy, but fundamentally how to think. And I mean, the results, they speak for themselves, don't they? He basically handed Buffett the blueprint to extraordinary wealth. But, okay, theory is one thing. Let's dig into how these principles actually played out in the real world.
Absolutely. And the sources give us some really compelling case studies that highlight this. Take Geico Insurance, for example. Back in the 1950s, Graham himself, through really meticulous analysis, identified that Geico was deeply undervalued. So he made a pretty substantial investment, even though it wasn't exactly a popular stock at the time.
Okay.
And then decades later, Buffett, his most famous student, you could say, ended up buying the entire company.
Wow.
And now Geico is a cornerstone of Berkshire Hathaway.
And it's not just about finding those hidden gems, those undervalued assets, is it? I remember reading about Buffett's purchase of the Washington Post. That was back in the 70s. He paid, what, $11 million?
Yeah, something like that.
When its real value was estimated to be well over $400 million. That illustrates another core principle, doesn't it? The moat.
Exactly, the moat. In investing terms, that's like a sustainable competitive advantage, something that protects a company's long-term profits and its market share from competitors. The Post had this incredibly strong, defensible business, deep customer loyalty, a dominant position in local advertising.
So it wasn't about quick gains. It was about durable quality, something built to last.
Right. And this brings up another important point from the sources. Even the most disciplined investors, they aren't infallible. They make mistakes. Buffett himself, famously admitted losing money on airline investments. He actually said he violated Graham's rules and, well, paid the price.
Even the best.
It just goes to show Graham's strategy doesn't prevent losses entirely. But maybe, as our sources put it, it's less about avoiding losses altogether and more about preventing stupidity.
And often, that stupidity comes from our own minds, doesn't it?
Yeah.
This deep dive really drives home that idea that just being smart, having a high IQ, doesn't necessarily make you a great investor. Being calm, being emotionally disciplined often does.
It's so true. If you look at the bigger picture, many of the common mental traps investors fall into are purely psychological, just stuff going on in our heads. We're talking about things like, herd mentality, just following the crowd without thinking critically.
Yeah, buying because everyone else is.
Or confirmation bias. where you only look for information that supports what you already believe.
Ignoring anything that challenges your idea.
And recency bias, that tricks you into thinking that whatever's happening today, those trends, they'll just last forever.
That's a really powerful point, that composure trumps sheer intelligence. But hang on, is it really just about being calm? Or do Graham's rules actually provide a specific framework, something that enforces that calmness, even when your gut is just screaming panic or buy?
Well, yeah, that's a great point. The sources definitely show Graham had practical antidotes for these psychological traps. He taught us to stick to a clear, predefined strategy, use data, use analytical rigor.
Not dopamine, not that quick hit for market swings.
Exactly, not dopamine. And of course, that famous line, be greedy when others are fearful, and fearful when others are greedy.
Right.
The core message really is, if you want to win at investing long term, you often have to learn to just do nothing when everyone else is panicking or getting overly excited.
Yeah, I can relate to that. You see everyone else piling into some hot stock and your finger just itches to join in. Graham's genius here seems to be giving you a practical framework, a reason to resist that very human urge.
And a really practical tip from the sources for mastering this psychology, especially if you see yourself as more of a defensive investor, is to set up automatic investment.
Set it and forget it.
Pretty much. By automating your investments, say, putting a fixed amount into a diversified fund every single month, you take the emotion out of the timing decision. You're basically advised to largely ignore the daily news cycle. I mean, frankly, it's designed to trigger emotional responses, right?
Absolutely. Fear and greed headlines sell.
So ignore that and maybe revisit your portfolio just once a year, not every morning on your phone. This really helps you avoid those emotional traps.
Okay, so that makes sense. But how do we apply the intelligent investor in today's world? I mean, let's be honest, 2025 looks a lot different than Graham's time. We've got AI, crypto, meme stocks.
Yeah, the landscape changes, but the principles themselves, they seem absolutely timeless. The sources suggest basically two main approaches, kind of tailored for different investor temperaments. First, for the defensive investor, the one who wants safety and simplicity. They suggest a remarkably straightforward plan, something like, say, 70% in low-cost index funds.
So those diversified baskets of stocks that just track the market, like the S&P 500, often through ETFs.
Exactly. Those exchange-traded funds make it easy. So 70% in those and maybe 30% in high-quality bonds or other fixed income things. Rebalance it once a year. That strategy focuses on consistent, broad market growth, much less volatility, much less need for constant watching.
Okay, that's the defensive route. What about the more enterprising investor, the one who actually wants to dig deeper, maybe put in more analytical work?
Right. For that type of investor, the sources point towards a different, more involved approach. They explicitly advise you to really study company fundamentals. That means digging into financial statements, understanding the business model, assessing management quality.
Not just looking at what's trending on social media.
Definitely not. They strongly caution against speculative IPOs, those new stock listings often driven purely by hype. And yeah, the general crypto frenzy. The emphasis is that true value investing needs a tangible underlying business, something real, not just promises based on speculation.
So where should they look instead?
The advice is to hunt for undervalued sectors, or maybe specific companies that the market has overlooked for some reason. Could be anything: energy, healthcare, maybe even smaller, less followed small cap companies.
Interesting. So even with all the new stuff, the core advice is still about finding real value that others have missed.
Yeah, and what's compelling here is that even in this world that's chasing instant gratification, speed, TikTok gurus promising instant riches, Graham's principles consistently reward patience. That long-term, disciplined patience, it's still a core pillar of intelligent investing. Seems like it always will be. So, okay, let's try to summarize the overarching purpose behind Graham's teachings. It's quite profound, actually. The book wasn't just written to make you rich. It was written, and this is a quote, to keep you sane in a pretty volatile world.
To keep you sane. I like that.
Yeah. So the key takeaways from this deep dive are pretty clear, I think. First, investing is simple in its principles, but it's certainly not easy in practice. Second, your emotions. Truly, your biggest enemy. Far more dangerous than any market crash. Third, understanding a company's fundamental value is absolutely paramount. Forget the fleeting price for a moment. Fourth, you absolutely must build your margin of safety into every investment you make. And maybe most importantly, it's not just about making money, it's fundamentally about protecting it, keeping what you have.
Yeah, and if we connect these really profound lessons back to you, the listener, back to your own journey, Benjamin Graham left us with this insightful quote. He said, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks."
That says a lot.
It really does. It underscores the personal commitment required, doesn't it? It goes beyond just financial knowledge.
Yeah.
So if you want to become an intelligent investor, it's not about memorizing stock tickers or, blindly following fleeting trends on your feed. It's really about learning to master yourself, understanding your own biases, your own reactions, and sticking to a rational framework. Because the biggest risk in finance, well, it's usually looking back at you in the mirror.
Oof. Yeah.
Take a moment, ponder that idea. Think about it. Look, this deep dive was just the beginning, a starting point. If you learned something valuable from this, something that clicked, share it. Share it with someone who needs to hear these insights. And drop a comment below. Tell us, I choose intelligent investing. Let us know it resonated. And always remember, wealth isn't built overnight. It's built with wisdom.